basis point cuts at each of the three Fed meetings this year. All right. Well, we have Stephen Englander, Managing Director, Global Head of G10 Forex Research and North American Macro Strategy at Standard Chartered, now joining in to take some questions. Stephen, good to have you with us here. Good morning. Thanks very much for your time. So just a quick word on the risk appetite and environment for risk, really. How do you assess it? There is the seasonality argument. Presidential years in terms of market performance is a little mixed going into elections at least. Will all that weigh, or do you think maybe this is just a very short underperformance kind of a patch and things will, it'll be up and up again? What's your sense?
Well, I think that it's too early to put on too many strategic election trades. And I think that those are going to fade. I mean, even though there's a general consensus that Harris did better than expected and Trump worse than expected, the betting markets are still pretty much 50-50 as far as who's going to win the election. So that's a very difficult trade to put on at this point. I think the bigger thrust is that it's clear, and markets are pricing this, a year from now, after the September 2025 meeting, Fed funds will be below 3%. If you can have a good risk appetite in an environment where you expect policy rates to drop, 235 basis points, you're in real trouble. And I think that the resilience of the market reflects the fact that, do they do a 15th September? Do they do it in January? It doesn't really matter. What matters is that the Fed is going to embark on a series of rate cuts, and the inflation picture is sufficiently positive, to make them confident that they can carry it through. So I think it will be a resilient market. We will have rates convergence. We'll probably get to see the dollar fall. Probably, we think, towards the end of this year and more into next year. But I think risk appetite will stay firm.
So, Stephen, 1 year down the line, as we navigate through a lot of the uncertainties, the extent of Fed rate cuts, the U.S. elections, do you think markets globally, say the U.S. markets, the mother market, will be higher? Could we see about a 10% return from here on?
I don't think that there's any reason to be at all negative on the market. I think that let me put it this way, the Fed put its back. And as long as the Fed is more concerned about unemployment than about overshooting on inflation, it means that at any sign of weakness, they'll be either increasing the policy response or going further than market expects. Without making a numeric call, I see the environment as being quite positive.
Stephen, hi, good morning, and good to see you in. Well, I wanted your view on the Indian markets. We have been the outperformers. So, what's the view on the markets? Because we're not particularly cheap right now. And also, how do you see an emerging market, the RBI? How do you see cuts follow what the Fed will do?
Well, first, happy birthday from New York, and many more to come.
Thanks a lot. Thanks a lot, Stephen. Appreciate it.
We're pretty optimistic on India. It's in a world where you have slow growth, chronically, right? We're debating how much growth will slow in the U.S. Europe is kind of stuck in the mud. China facing, clear headwinds. India stands out as one of the places where growth is relatively firm. We do see the 50 basis points of cuts by the RBI. Growth will slow a little bit, but it's not going to slow materially. It should continue to be a very positive environment. I think global investors will be looking to put money into India.
Stephen, we'll leave it there. Good conversation as always. Thank you very much for joining us and running us through all of that. We'll take